Good
morning, everyone. I'd like to welcome you all to our webinar this morning, Selling Your Business to Private Equity. We're going to start in a few minutes, give some people a chance to sign on, and then we'll get going. I'm just going to close my door. So just so you know, Tom, we cannot see you. That's what you want, right?
Yeah, I want them to see this screen.
Okay. Unfortunately, they see me.
They don't need to see me read my notes.
Let's give it one more minute. Yeah, people are still logging on. Terrific. All right, I think we'll go ahead and start. Again, I'd like to welcome everyone. Good morning. Thank you for joining us. We're very happy to have you. My name is Steve Brandell, and I run the Heffernan Life Division here at Heffernan. Been here about 8 years, been in the business over 30. I dated myself. We're very happy and privileged to have with us this morning our private equity group. We've got Tom Kashiki, who is the director, managing director of the division, and we've got Rob Jevons, who's the operations manager, and they're going to talk a little bit about selling your business to private equity. A lot of business owners these days want to know what their exit strategies are, want to know all their options, want to make sure they're doing the best thing for their business, themselves, their families, their employees. So we're lucky enough to have this division who can help our clients with those types of questions. So that's what we're going to talk about today, specifically with the private equity option. So Rob, I'm going to throw it over to you. Why don't you tell us a little bit about yourself and Tom?
Great. Yeah, thanks, Steve. So again, Rob Jevons, I'm the Director of Operations for the Private Equity and Mergers and Acquisitions practice here at Heffernan. And without getting into, I guess, the weeds of it, the simple story is this. We're a resource group for the firm in that when Heffernan producers come across a private equity firm or a client who's getting acquired or a client who may be acquiring another entity, we will assist that advisor in with their client performing insurance due diligence on that target acquisition, which is kind of a customary process. When your business is being sold, the buyer is going to basically turn over every rock to get familiar with your business. Be it from a legal perspective, tax, insurance, environmental, if there's any environmental aspects of the business, any manner of operations of the business is going to be due diligence by the buyer. So we handle the insurance due diligence, and then we also work with a suite of products called the Transaction Liability Suite of products, which most notably reps and warranties insurance, tax liability insurance, contingent liability insurance, and litigation containment, which is, again, just a suite of insurance products that are used to help facilitate an M&A transaction. And then we are also, the practice, we are also, one of our mandates is to go out and network with private equity firms and other strategic acquirers to help them with their acquisition process. So I guess what's important for the audience here to know is that when you folks, as owners of your business, when you're preparing to sell your business, and Tom's going to talk about this in a minute. Eventually, you're going to hire. It would be prudent to hire an M&A advisor, either an investment bank or a business broker. Just like if you were to hire a realtor to sell your home, you're going to want to hire a business broker or an investment banker to help market your business and find an appropriate buyer and negotiate the most favorable purchase price for you as a seller. And we can help you in that regard with our wide array of contacts. By way of the just transactions we do, we run and rub shoulders quite a bit with business brokers and investment bankers. We can help introduce you to these folks to help you with your process and advise you from the sell side. So with that, I will turn it over to Tom, and he will get a little bit more into the weeds as far as how you want to prepare your business for sale.
Hi, everyone. I'm Tom Kashicki. I'm the private equity and M&A practice leader here at Heffernan. Going to be going over, obviously, how to sell your business to private equity. A couple of things that we're going to be talking about. We're going to be talking, I've broken it into 5 different parts. First of which is key considerations to just really mull over as you're ready to, thinking about selling. Some common traits that you'll see in private equity transaction. Then we're going to switch gears a little bit, and I'm going to go through the stages of a private equity transaction. I'm going to let you know sort of what's going to be going on your end, the business seller's end, and also what's going on inside, probably something that you might not be familiar with, what's going on inside the private equity firm at that point in time. What are they doing? How are they analyzing your business? I feel it's important to go over that, just to give everyone the opportunity to see, like, oh, what is this PE doing when they say they're due diligencing me? What is this PE firm doing when they say they're coming up with an LOI? I think it's very important. Next, we're going to shift gears again and go into tips for selling to private equity, and I have some tips for folks, to sell to private equity. The most prescient of which is really assembling the right team. You'll hear that as a theme throughout this presentation. And then the last section we'll touch on is misconceptions of selling to private equity. So just some misconceptions you may hear on the street, that it's all bad news. It's all they're going to pillage the company. It's not necessarily like that. So to begin with, selling your business, there's options out there. You can sell to a strategic buyer, which would be selling to someone, in your industry. If you own, say an HVAC business and you want to sell, you'd sell to another guy in the HVAC space, maybe a bigger guy, maybe, someone that a competitor, you'd want to do that. Second option would be selling to a private equity firm. Third option would be sell to the management of your company. The management team, would ideally, could be an ideal buyer as well, because they know your business. And then the fourth option, which, we're not going to go into, but we have some great webinars on, is selling it to your employees or selling it to an ESOP, an employee stock ownership plan. This presentation is going to deal with selling to a private equity firm. So some key differences or some key considerations to think about when you're selling to a private equity firm and a strategic buyer. The first is which is the speed of the transaction. When you sell to a private equity firm, things are going to go fast. When you sell to that strategic buyer, it's going to move at the pace of the strategic buyer. If you're looking to unload the business fast, those sorts of things, private equity is probably the right move for you. Deal pricing. I'm not going to go too into the weeds on how they come up with pricing. Some of that's what financial engineering that private equity firms do, but know that it's going to be a multiple of profit, multiple of EBITDA, in order to arrive at a price, and that's going to be based on your industry, based on what they see in that space. Sometimes you can get better pricing from a strategic buyer. Sometimes you can't. Each buyer is unpredictable. As far as the financial goals and deal structure, the private equity firm is going to have a continued investment and maybe even have a potential second liquidity event when they flip your company. When you sell to a strategic buyer, again, if you're that HVAC company and you're selling to the big HVAC guy, it's usually a single sale and you walk away. Which leads us to the next point. There's some uncertainty as to when you sell to private equity, when your company will be resold at a later date. They could hold it for 3 to 5 years. They could hold it for 2 years. They could hold it for as a longer term as a platform acquisition, and where they try to tuck in other companies under yours. Whereas when you sell to a strategic buyer, you're just basically going to be absorbed. as far as employee security is concerned, the private equity firm is a private equity firm. They're not running your business. They let you run your business for the most part. So they're relying on your team. Whereas a strategic buyer, there may be some redundancies and there may be some job losses. Think about if there's an accounting function at your firm currently and a strategic buyer buys you, they may not need all of that accounting function. Things like that might be an issue as to employee security. I can go through the rest of this, but as you can see, the main point here is that private equity transactions typically happen quicker. They typically happen at a multiple of profit, and they rely on your team. Whereas selling to a strategic buyer, as you're probably well aware, is selling to it's a single sale to another competitor or someone in your industry space, where it's going to tuck your business into their business. So that's really sort of what this slide says. Selling to a private equity firm usually requires you to stay invested for a little period of time. It's important that when we get to it, you determine what your goals are, whether you want to stay with the firm or you want to complete and total exit. If you want to complete and total exit and you just want to cash out, private equity might not be the solution for you. That's why I was saying there's sometimes the second liquidity event when in a private equity sale when they retrade your company. Selling to a strategic buyer usually allows you to cash out right away. So that's a consideration to think of. Some common traits. I'm not going to read all of these, but I'll go over some of the most salient ones. The valuations tend to be predictable and are based on multiples, profits. You'll hear me say that several times during this presentation. They'll buy the company for cash. However, they usually require the rollover. When you invest the proceeds back into the company alongside the buyer of equity to demonstrate a continued commitment to the company. The PE firms generally back existing management teams, so you and your team are probably going to be asked to stay on and guide the company, or at least if you make an exit, at least the senior management team, they may get employment contracts or whatnot. Generally, the private equity firm is using debt to fund the transaction. They've gone out and raised a fund. They've done that to increase their and your equity returns. They may use an earnout. Again, some of this, is purely academic, but I think that it's important to just understand, what some of the common traits are. They may use an earnout, future payment from a buyer that can vary with future results, but mostly rely on your minority interest to encourage you to continue to grow the company. Remember, the goal of the private equity firm is to realize returns in their investment, and this can be twofold. And you could realize returns as well. So you have a successful business, and you've received a call from a private equity firm, or maybe you've engaged a business broker or an investment bank, as Rob said earlier. What do you do? How what's going on behind the scenes? So now we're going to go into what's going on behind the scenes and how private equity transaction really takes place. There's 5 basic parts to it, and I've broken those 5 basic parts down, and gotten a little granular on them. But there's the approach stage, where deal sourcing, deal origination, that can either come from an auction process, it could come from from your investment banker or your business broker who are out there, or it could come something as simply as private equity firms, just like everyone in sales out there today, makes cold calls. They do equity research. They look to see what companies are out there, what are attractive, who's making money, who's available, who's in the space. Maybe they have a platform of, again, I'll use HVAC contractors just as a basic example. Maybe they have 3 or 4 in their portfolio, and they're looking to build a platform acquisition, where they can add another one on. They might be looking for businesses in your space. Second part is the due diligence and negotiation. This is where the heavy lifting gets done. We're going to get to a lot. We're going to get a lot deeper in this in some of the future slides. Next is the marriage, the deal closing, the acquisition, and what happens post acquisition. This is when you've sort of relinquished control of your company, you've sold to private equity, you've cashed a considerable amount out of it, and you're waiting possibly for that second liquidity event. Then there's the divorce, the exit, whether private equity company decides to take your company public, whether they do a sale, sale to another private equity company, which is generally what we see in the space, or there's some sort of a buyback, and then repeat. This happens over and over and over again in private equity transactions. So first stage is sourcing and teasers. Now, if you've engaged a business broker or investment banker, they're going to be doing some of the sourcing for you and on your behalf. They're going to market your company with what's called teasers. They sent it out to private equity firms that are, they have relationships with, saying, and a teaser is, right there. It's a 1 or 2 page summary sent by the financial intermediary, again, a business broker or investment banker, about the company up for sale. It's just like it's that little sheet without giving a name of the company, because remember, we haven't entered NDAs yet. That comes in the next stage. Just basically saying, hey, there's this company, there's this HVAC company, we're selling it for, we're looking for purchasers for it. So that's how, the deals get sourced, as I said before, through equity research, internal analysis, networking. I was just at a private equity conference last week in Las Vegas, and as we all know, one of the biggest reasons we go to conferences is to network. And who's there but every PE firm worth its salt, and every investment banking firm worth its salt to try to source deals. Cold calling works, and just like in every other form of sales. That's how the deals are sourced. When you get the teaser out there, you would review it. It's probably a good thing to know, and we'll get to this later in the tips section, but it's advisable to know the rough value of your company at this stage, so they're not throwing a number in front of you which just may seem like a great number, but in actuality it might not be a terrific number. So it's always good to have a value of your company in mind. The second stage is this, it's pretty easy. It's signing an NDA. This is, if the private equity firm is interested in the prospects of the teaser, they'll move forward by signing an NDA with you. Upon signing the NDA, with the investment bank, they'll provide what's called a confidential information memorandum, or a CIM deck. You may have heard that term used. It's basically an investment thesis that contains financials, projections, and the capital structure of the company, of your company. This is put together by the investment bank or the business broker. It's a little bit more in depth. Now that you're under NDA, they can disclose who the target is. So it's Jack's HVAC business that could be disclosed. You're under NDA, so you don't have to worry about others finding out that you're in the process of selling. After signing the NDA, the private equity firm is going to begin the initial due diligence stage. You're going to see that there's quite a few due diligence stages in a private equity transaction, but this includes industry research and gathering as much information about the industry, not just your company, but about the industry, and putting together a financial model of how the business should perform, after acquisition. Another huge it's doing, it's a huge piece of it is doing the projections provided by the company's management. You may also want to get in touch with the investment bank to learn about the company from the perspective and potential debt financing options that are available for the acquisition. So it's probably good at this point in time to talk to your investment banker to find out, how this deal is going to be funded, what's going to go on behind the scenes. We're now going to enter what the private equity firm is doing right now. After the initial due diligence, their investment team is preparing an investment proposal to present to their investment committee. They've reviewed the SIM deck, they reviewed your pro forma financials, they reviewed the information on your business, they reviewed what the investment bank has provided them, and they're putting together an initial proposal. It could be a simple update. It could be something more complex, but that's what's happening. When you're not hearing from the private equity folks, for a week or so, that's what's happening is they're putting together an investment proposal at that point in time. They may even submit a first round bid at this time, but each private equity firm, and how they do it will vary. That gets us to the first round bid, which is a binding letter of intent, an LOI. You may have heard of an LOI before. The investment team is going to provide, you, the target company, Jax HVAC, with a non-binding letter of intent for the transaction. That basically, it's what the purchase and sale agreement is going to be based upon. It just breaks everything down into certain sections. What's going to happen. It speaks to the purchase price. It speaks to some of the value creation that the PE firm is going to bring. Speaks to all of the salient points of the transaction. It's not a purchase and sale. It's not an 80-page purchase and sale agreement. It's a 4-page document that really says this is the intent to enter into this transaction. At that point in time, you would then sign the letter of intent, and you're really off to the races. Off to the races means more due diligence. At this point in time, your investment banker or business broker is going to set up a virtual data room, put all of your information in it. It's going to put your insurance information. It's going to put your cyber information. If you're an industrial, it's going to put your environmental information into your permits, your phase 1s, your phase 2s, all of that information into virtual data rooms. So the private equity firm can then analyze it and do their more in-depth due diligence. The information that you're going to see that goes in there, it's going to be the legal records for the company, the organizational documents, formation documents, it's operational records, the meeting minutes that you do every year, reports, the meeting minutes, any documentation you may have related to intellectual property, your financial information, including audited and unaudited financials. Just a piece of advice, the stronger financials you have, the better negotiating position you're going to have when it comes to negotiate with the financial, the price with the private equity firm, but we'll get into that. It'll also contain employee details and it'll outline out if there's any employment agreements that are out there, maybe with key management folks that you may have employment agreements with. The private equity, and going back into the private equity firm, what they're doing is they're doing their financial engineering, and they're creating an internal model. That's what they go to business school for. It's what they learn. It's what they do. They create an internal operating model. It may be, very similar to the model that you use to run your business. It may be completely divergent, but based on their expertise in the sector, based on their expertise in the space, they're going to be putting together an internal operating model of how to run your company. I just put some key considerations there. I'm not going to read them for you, but you could take a look at them. And just one point, this presentation, there's a lot of information in it, is available after this. You just email us, and we'll be able to provide you with the presentation, for your review, your personal review, since we have so much information to cover in a limited time. Then comes another document that's internal to the private equity firm. All this while you're just biting your nails as due diligence is going on, but what they're presenting is a preliminary investment memorandum. That's to the private equity firm's investment committee. That contains, a certain number of sections, an executive summary, details about the transaction, background, the deal team, recommendations, and again, that investment thesis that they began with. The company's overview, do, a description of the target, the products and services that they supply, maybe a history of the company, its suppliers, its main competitors, its main customers. Are you overly reliant on 2 or 3 customers, or do you have a broad customer base? That type of information is going to be in there. It's going to have some biographies of key management and include the organizational structure as well. There'll be a market and financial overview. The market overview is pretty obvious, just market growth and trends in the space that you're in. Financial overview, past and projected income statements. Basically, as I said, if you have audited financials, not that everyone has them, but if you have at least reviewed financials, providing them at this point in time would be a great thing as they do their due diligence and come up with a evaluation overview. They're also going to look into key risk areas, risks that are identified, that they're identified in the business. They've identified in due diligence, just key areas of risk. Whether that is something is being overly reliant on 1 or 2 customers, or it's really going to be dependent on the business space that you're in. It's going to have exit details. You're not going to see this, but it's going to have what their plan is as far as exit. Are they going to hold on to this company for 3 to 5 years, get it to run more profitably and then flip it? Are they going to use this as a platform to acquire more companies? That's going to be in there. It's going to be in that preliminary investment memorandum, along with the proposed project plan. The deal team usually performs only the initial due diligence up to this stage due to the high costs and the fact that deals sometimes can go south at this point in time. The legal due diligence, the real heavy lifting is carried out a little bit later. Right now, the final due diligence stage. After that memorandum is prepared, you go into final due diligence. In this stage, the private equity the private equity investment flowchart, the deal team typically interacts with the investment bank and the management of the target on a daily basis. So you will be getting calls from both the investment bank as well as the private equity deal team. Hey, how do you do this? What's going on with this? All of just salient questions, about running your business, about what makes it tick. Again, we've set up that virtual data room, so we hope that the process is as inobtrusive as possible. But sometimes the process does get to be a little, I'm not going to say obtrusive, but it'd be good to not plan vacation during this period of time, because the private equity firm and the investment bank are going to rely on you for a lot of the information. There's things that just aren't completely evident from reports or from documents. Sometimes they want to hear it from the horse's mouth, hear it from the business executives, so to speak. Furthermore, they'll start negotiating with banks about debt financing options, aiming to secure the best debt terms with the group of banks. That's what the private equity firm is doing to get their lowest cost of entry to secure the firm. I put it takes between 3 and 6 weeks for the due diligence process in private equity from first round bid to final bidding. That timeline can be compressed to about 2 weeks, and it can be expanded to about 8 weeks. Again, as I said in the beginning, private equity transaction is going to move quick. I mean, if you think about it, 3 weeks for them to go over everything in your business and go from soup to nuts is not a long time. 3 to 6 weeks. It can move very, 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 very quickly, because there's a lot of people invested in the process. What's going on back in the private equity firm at this point in time? They're getting final investment committee approval. They've gotten tied all their loose ends up. They've created what's called a final investment memorandum. They've circulated that with the investment committee, and it addresses any due diligence, any warts that may be out there in the company and whatnot. Hopefully they've gone over that with you and with your counsel. Really just hammering everything down and getting everything done, getting ready for signing. and that at that point in time they give you the final binding bid. That this is a stage where you're this and the next stage sort of go hand in hand. The bid, includes final pricing, financing documents from the investment banks, any preliminary merger agreements. So the first round of the purchase and sale agreement is going to be circulated with the council at this point in time. It's going to really embody everything that, going from that letter of intent all the way into their financial information memorandum. And then, last but not least, signing the deal. Once the seller with investment bankers and advisors pick a winning bid, this is if it's in an auction, because sometimes we're not going to go into it right now, but sometimes there's an auction process for your business and there's multiple bidders, but we're assuming that there's one bidder right now that you've already and entered into exclusively an exclusive NDA with. Once they've done that, the purchase agreement and other documents are negotiated between the lawyers of the buyer and the seller, and you sign it, and the deal gets funded, and off you go to the races. Tips for selling to private equity. I think that this is you really pay attention to some of this. This is some of the tips that I'm a former M&A attorney, and these are some of the tips that I would advise my clients when selling their business to private equity. First, stop, look, and listen. Don't commit to anything up front. Again, it's good to know a rough valuation of your business at any point in time, but don't commit to anything. You may be approached. It may be a good deal. It may be a bad deal. You don't know. Don't assume that it's the best deal that's out there. Assume that the private equity firm has better information than you have sometimes. Because they may be invested in this space. They may own 5 HVAC contractors already, and be looking for you for a platform acquisition. You just don't underestimate the private equity firms. Gather as much information from the PE firm as possible by asking questions yourselves. Again, they're buying your business. You have every right to ask them questions at your consent. How did you arrive at the purchase price? Can you provide me with the market data that shows me that your purchase price is fair? What other deals have you done in this industry, and why are you targeting me? Why are you say you don't own any HVAC contractors. Why are you targeting this one? Are you looking to build this out? Why my company? Just like anybody else, get some references from them. Do your homework. So don't commit to anything up front, and do your homework. Consult with your lawyer, to get a bulletproof NDA, because you don't necessarily want on the street the word that your business is for sale. Next thing you should do is determine your goals. What are your goals when you're selling a business? Do you want to walk off into the sunset? If you want to walk off to the sunset and sell your entire equity stake, maybe selling to private equity isn't the solution for you. Maybe that's selling to a strategic buyer. If you want to stay for a period of time, take on a new challenge, and perhaps get that second liquidity event when a private equity resells your business, then maybe you would stay for a period of time, 3 to 5 years, where you would be an executive with an employment agreement at your own former company. I mean, you'll have to get used to the fact, and think about whether you're comfortable running the company with a new majority owner. Remember, private equity is going to own you at that point in time, where if they're doing an LBO leverage buyout, they're going to own a majority stake in your company. Think about that, and think about do you want to work for your own company that you got from the ground while working for someone else? Now, we're going to get into misconceptions, and one of the misconceptions is that that's always bad. We're going to get into that later, but in any event, it's never too early to start having these important conversations with your family and friends. What you want to do with your business, how you want to divest it. This is probably, I would say, the most important step is assemble a team you can trust. The team that you have going out there of experienced advisors is really, how you're going to get the best deal and how you're going to get the most through any private equity transaction, or any transaction, whether you sell it to an ESOP, whether you sell it to a strategic buyer, whether you sell it to management. No matter what you do to divest your business, having the right team in place is key. First thing you want to do is hire the right attorneys. Yes, attorneys are expensive and no one likes hiring them per se, but it's it's, are you hiring a lawyer that, represents and sells companies to private equity firms, or you're hiring, your cousin who does estate planning? You really want to have the right attorney in there because they're going to be able to negotiate best on your behalf. Does your attorney understand your goals? You're going to want to have a good conversation with that counsel, and and let them know what your goals and objectives are, so they can best negotiate on your behalf. Does that firm have the technical expertise for tax, intellectual property, benefits, litigation, insurance, and whatnot under one roof? You don't want to be as they do due diligence on your firm, these are some of the areas that they're doing due diligence on. They're doing due diligence on your intellectual property. They're doing due diligence on the insurance that you carry. They're doing due diligence on the environmental exposures that your business may have, or the real estate that you may own. So it's extremely important that when you're hiring counsel, you look for a firm that has all of this under one roof. Again, there's nothing wrong with hiring someone's cousin, but it helps if the cousin works at a law firm that has all of these practice areas under one roof. It's kind of like you wouldn't hire an estate planning attorney to represent you in court. You should be hiring a seasoned M&A attorney to represent you in an M&A transaction. You're also going to want to hire an investment banker or a business broker. They may approach you, you may approach them, but they're the ones. It's like hiring a good realtor. That they're the ones that are going to be marketing your company. You want to hire the right insurance advisor. One of the biggest due diligence items out there is your insurance that you carry. You want to hire the right advisor that's going to be able to look through the program that you have currently, knowing that that program may change under the financial ownership of the private equity sponsor. Last but not, certainly not least, you want to hire the right accountants and financial advisor. Again, you may have your cousin doing your accounting, but at this point in time, you may want to, and that may be perfectly fine for the transaction. They may work at a robust firm that has the capabilities. But again, you want to make sure that, similar to your law firm, that your accounting firm can handle the transaction that you're about to go through. Understand the market of buying and selling. I'm not going to go through everything on this slide, but just understand the marketplace. Understand, that the private equity firm is doing their homework. That you need to do yours. It isn't just field. It's you're going to be doing some more homework than say you would be doing when selling a house. That's why it's key. It's important to have a savvy investment banker, to have a savvy attorney, under yourselves that are going to help you and help you best understand the market that's out there. That's key, understanding that marketplace. Understand market positioning. How's your company positioned in the marketplace? How does your company compete against similar businesses that private equity might be evaluating? Again, they may be evaluating multiple businesses in your space. Understand really your market positioning and how you position yourselves. Make a case for why your buyer should not just go offer or close on a deal based on similar multiple with one of your competitors. If they bought a 5x of a competitor of yours, maybe you feel that your company is worth more than 5x. Well, give them some reasoning. Show them how you're positioned in the marketplace. Show them what you plan to do, why you're different. What your market positioning is incredibly important to display to the private equity firm. Also be aware of what disadvantages you might have in this respect. Items that decrease value and need to be remedied, fix them before the process starts. If I can say one thing, if you had some tax issues in the past, if you had any issues with maybe some employees, maybe a litigation, try to fix those things before you deal with sale, because it's all going to come out in due diligence. It's all going to be out there, and you want to just be best prepared to deal with those things up front. Concentrate on your areas of maximum value. I think that goes without saying. Any good private equity firm knows what drives value and focuses on those. You want to focus on those as well. Just moving along. Create and maximize leverage prior to exclusively. I can't talk today. Exclusivity. You know, you can create leverage by creating a sales or auction process for your company, you know, or your business, or by assuring that the private equity firm believes there's an actual competitive sales process. Remember, it could be an auction. You know, your investment bank could be setting up an auction for your business where they've gotten several private equity firms to take a look at it, or it could just be one buyer. But you want to, no matter what you do, and again, I'll make this presentation available for folks afterwards. What you want to do is just create and maximize your leverage position prior to exclusivity with the private equity firm. I would say the second most important thing after getting the right team in place is get your corporate housekeeping in place. You know, what kind of company structure do you have? Are you an S corporation or an LLC? That's gonna, you know, when the company buying you, it's gonna mean something. Are you a C corporation, which is pass through, you know, like an LLC? It's you know, these things are going to be important. So talk to your corporate and tax lawyers and make sure that your company is buyer compatible and ready to market. You know, do you pay taxes in the state you know, where it's required? Are there any outstanding litigations, you know, maybe with a disgruntled employee? You know, are all employees properly classified as exempt or non-exempt? You just want to do all of your corporate housekeeping at this point in time to make sure all your ducks are in a row, because anything that's, you know, malaligned is going to come out during due diligence, and it's best to, you know, anticipate what the questions are going to be from the private equity firm than to sit there and be left flat-footed. So again, you know, bad housekeeping can derail a deal. You know your business up front. You know, continue these some other things. You know, as I just said, the ideal to fix things is to fix things before you get that call to sell. You know, if you're thinking about selling, you know, do your housekeeping now. It's probably, you know, you'll find any, you know, as you see here, any skeletons in the closet, any of those sorts of things. Address them now before you're ready to sell. Then get your personal housekeeping in sale. What are your personal goals, your business succession goals, your financial goals? Get that, you know, are you going to be making tax advantage gifts to heirs? Any of those sorts of things. What are you going to be doing with the proceeds of your business? These are some incredibly important things that you're going to want to be mindful of. You know, again, skipping back to, you know, to some of the beginning slides. You know, you want to know with what you want to do with the cash that you're going to come into. You're going to come into an incredible amount of cash, you know, a multiple of your earnings. You know, it'd be best right now, you know, in concert with your corporate housekeeping, to just get your personal housekeeping in order. In conclusion, I'd say start the process early. Allow enough time to explore all of your options, including a sale to a family office, a strategic buyer, an ESOP, etc. Start that process early if you're thinking of selling. Hire the right advisors, put the right team in place, whether it be an investment bank, a law firm, the insurance brokerage and accounting firm. You know, get the right advisors in place. Analyze your numbers, do your homework from that front. Expect that the numbers are going to be sliced and diced by the private equity firm. You know, they hire, you know, their Harvard MBAs to do financial engineering. Expect that it's going to be, the numbers of your company are going to be looked at every which way till Tuesday. As we said in the first slide of tips, wait for the right buyer. It's just not the first buyer. Wait for the right buyer for your company. Do your own homework onto their reputation. Do they have a good reputation? Do they have a good experience reselling entities? Be confident that your business and its team will survive under the new owner. You know, that's important. You know, do you get that vibe that you just don't think that you're going to gel with that management, with the private equity team? Trust your gut in that situation. You know, do you get the vibe that they're going to be a good owner? They're going to leave you alone to run your business the way that you've been running it profitably? You know, you want to trust your gut in that situation, and also lean on your advisors. Last but not least, expect change after your business is sold. There's new owners, so they're going to do some things different. You know, whether it's a different benefits package that they have out there, whether it's you know, certain ways that they run the business, certain efficiencies that they see. Don't take offense. Don't take it personally. Just be prepared for a change. You know, expect it. It's going to happen, and it's not necessarily going to be bad. Some briefly, you know, as we're running a little short on time. So some misconceptions of selling to private equity. I'll just breeze through these. One is that all private equity firms are alike. They're not. Just like with banks, just like with law firms, they're not all alike. The way that they source deals, the way that they operate, the way that they hold companies, it's all different. So again, doing your homework up front is incredibly important here. In the majority of cases, all the firms we're seeking to acquire businesses with an established management team and growth potential. So they're looking for a company like yours that has an established management team and has shown growth. Assuming that they're going to create complete operational control. This is going to vary. Some private equity firms are very hands-off and let you do it. Some are a little bit more hands-on. This is going to vary by the private equity firm. Most of the time you'll be able to justify the head count that you have. Sometimes you won't with a private equity firm, but if you're going to a strategic seller, there's definitely times where head count's going to be under much more of a microscope, again, because of the duplicity of functions that happen with a strategic buyer. Secondly, in many cases, the PE firm will seek to add to their team to the board of directors of your company. So they're going to put an individual from that's not going to run the day-to-day, but they're probably going to sit on your board of directors, and they're going to be active in the planning of your business. Don't take this as an affront or anything like that. This is fairly common. Firms with operating partners will bring these people into portfolio companies and executive roles if needed. You could read what we have there, but just be prepared that not all private equity firms assume complete operational control, and many will let you run your business as the way that it is, and simply just stick a board member on your board. Again, know that cost cutting is, will be inevitable. If you're leasing, a Mercedes-Benz through your company right now, they may say like, okay, Jim, maybe a Mercedes might not be the car we're going to pass through the company on this, and maybe you want to think about something else. But those are the type of costs that they're going to be looking at. Just be mindful of that. When you're doing your homework, that there will be inevitably there will be some cost cutting, because in order to increase profitability, you're going to get that through both growth as well as cutting of costs. But expect some cost cutting. Not to say that it's going to be mass scale layoffs or whatever, because you're not going to be able to run your business profitably in the way that you can if you don't have a staff. So be mindful of that. Know that aside from cases involving PE firms, restructuring and/or job losses occur more often when it's brought in by a strategic buyer. Again, that's some wisdom I just want to impart with you, that more often you're going to see the layoffs and those sorts of things when a strategic buyer comes in. While it's naive to expect that there won't be some cost-cutting, PE firms typically increase profitability through growing the company, positioning your company, a certain way. That's really all I have. Sorry that I went through everything so quickly. We only have an hour to go through a lot of information. Again, we'll make this presentation available to you. At this point in time, I'd like to open up the floor to any questions, whether it's on something that we've touched or something that we haven't touched in the presentation.
Thank you, Tom. We do have some questions here that I'm going to go through. The first one is, can you explain the multiple of the EBITDA concept? For example, if it's a doctor's office and the doctor takes 90% of the income as a salary, what will the PE firm pay the multiple on? Is it the income before or after the doctor takes his salary?
That's gonna depend, and that's when you go looking into the corporate structure. So your doctor's office may be set up as an LP, a limited partnership. You and another partner, or maybe you might be a sole proprietor. They look at both, honestly. They know and understand that if you're set up as an LP or an LLC or a pass-through corporation, that your profits, do go to pay salary. So they do look at that. So the multiple isn't, if you're taking, just for easy numbers, you made $100,000, you take 90,000, of it as salary, and rightly so. They're not going to look at just that $10,000 in profit, over and above. And while they do look at EBITDA, they're not going to look at just that. They're going to look at how you pay yourself. They're going to look at, really the tax structure of the company and the corporate structure of the company. So it's not just EBITDA, that's something that flies around, that's in professional corporations. It's not as it's not as reliant on that, though. To the extent that they do, they give a higher multiple of EBITDA, so you might see 15 times, 12 times, as opposed to 4 or 5 times, taking into account that that's how doctors pay themselves. I hope that addresses your question.
Very good. The next question was, will we be providing a replay of this webinar? The answer is yes. It's been recorded, and everyone who attended will get a recording of it sent to them, and everyone who registered and couldn't attend will also be getting one. The next question is, what is the role of an insurance advisor in a private equity sale?
Well, twofold. The insurance advisor, could guide, first to guide the process. As Rob had said, there are certain insurance products out there, transactional liability products called, which is reps and warranties insurance, which go hand in hand with a private equity sale, or with a strategic, with any type of sale for that matter. And the insurance advisor will help place some of those products, which, I'll go to the nuts and bolts of a reps and warranties policy. What it does is, usually in a sale, there's an escrow that's left on the table, that's left there, sort of as earnest money after the and it's left there after close, and it could be anywhere up to 10 to 15% of the value of the company. So if you sell your company for $100 million, there could be anywhere from $10 to $15 million left on the table, an escrow, in case anyone breaches any reps and warranties in the purchase and sale agreement. If what a reps and warranties insurance policy does is it steps in the place of that escrow, and it allows you to remove the escrow, and it effectively insures that, so you could clear that $10 to $15 million, in addition to the other $85 million that you'd be realizing from the sale. You could clear that at once, and you'd effectively be insuring the escrow. Not to go into so much of a product dump, but this is some of the things that an insurance advisor could do, along with helping with the due diligence on the insurance on the company, to make sure that the company that you're selling, that it's been insured properly, that you have all the right coverages that are out there, because the private equity buyer is going to, want to know, okay, maybe you've been under purchasing, and for a good reason. You've been under purchasing in capacity on property insurance, because you're in an area that doesn't have earthquake. We're in California, or you've been buying high limits because you buy earthquake insurance. These are some of the things that the insurance advisors can advise the private equity firms, saying, hey, they're buying this, well, why are they buying so much capacity in insurance? Well, they're buying it because they said, in an earthquake area. It's sort of dumbed down, but really advising them that the insurance and the risk mitigation measures that are being undertaken by the company are done and are appropriate. Do you have anything you want to add there, Rob?
No, I think you summarized it accurately. The kind of going up to the transaction liability suite of products, that is probably one of the key areas, if not the key area, that an insurance advisor could assist on the sell side, is by preparing your business for that process, and what the buy side reps and warranties underwriter is going to be looking for. The transaction liability underwriters, they do not perform due diligence on the target company directly. They are totally dependent on the third-party due diligence reports that are provided by, or that are commissioned by the buyer. And you just want to make sure that you have your house in order in advance of going through that process, again, with the objective of taking all of the money off the table at close, without 10-20% of your purchase price being held up in escrow for 12 to 24 months. you can walk away with that, all of that, and leave the insurance policy in place to indemnify the buyer.
All right, very good. And we have the last question is, how long is the normal time between an NDA and an LOI?
Usually around a week. If you think that the entire process can take anywhere from 3 to 6 weeks with the private equity firm, around a week from an NDA to an LOI. They're just getting their ducks in a row, getting their initial investment thesis together. So you could generally a week, maybe 2 weeks, but generally a week from that NDA.
And it looks like that's the last question. Yep, I don't see any more. If nobody else has any questions, I want to end by saying thank you, Tom. Thank you, Rob. Very informative. Really appreciate all the information. And everybody, like I said, who registered for the webinar is going to get a copy of the recorded version. And I see, Tom has his information on here right now, but I'll include everybody's information, myself and Rob as well, so that if anybody has any questions, they know how to reach us. But other than that, I just want to say thank you very much for attending, and everybody have a great day. Thanks, guys.
Thank you.
Thank you.
Take care. Bye-bye.
Bye.
You'll have to take it to get a new tire, period. Can you take it to the closest bike shop tomorrow? Question mark. Ideally, comma, you walk it home, comma, and leave it in your garage until after Northridge, period. However, if that's not possible, comma, then leave it where it is, period.